leaked memo, why Morgan Stanley is panic selling all silver holdings right now. A confidential memo dated 3 weeks ago. Morgan Stanley's trading desk receives an order, liquidate everything, every silver position, every contract, every holding, immediately, no questions asked. Within 72 hours, over $2 billion in silver gone. The world's 5th largest investment bank, abandoning a safe haven asset in complete silence. They know something the market hasn't priced in yet, something that could reshape the entire precious metal sector. And they're moving before anyone else can react. The question isn't why they're selling. The question is, what are they seeing that we're not? Welcome to Financial Inspection, where we examine what institutions do, not what they say. Now, if you've been in the markets long enough to remember when a handshake meant something, when research was done with paper and a sharp pencil, then you understand the value of real information. Do us a favor. The same way you'd ask a trusted colleague to join you for that morning briefing, hit that subscribe button. Because the stories we investigate here, they don't wait for permission. And tell us, where in the world are you watching this from? What markets are you protecting right now? Let's begin. On the morning of December 18th, 2024, a document appeared on an encrypted financial forum. It was a single-page memo marked internal use only, bearing the Morgan Stanley letterhead. The directive was simple and shocking. Effective immediately. Liquidate all silver positions across proprietary trading accounts. Execute within 72 hours. Minimize market impact. No exceptions. The signature at the bottom belonged to the head of commodities trading, a 30-year veteran who had weathered every market crisis since the 1990s. Within hours, financial analysts around the world began verifying the document, cross-referencing trading patterns, checking market data, watching for unusual activity. And there it was. Morgan Stanley was selling aggressively. Between December 19th and December 21st, over 15 million ounces of silver changed hands through complex derivatives transactions. The bank unwound futures positions, sold physical holdings stored in London vaults, and terminated long-term supply contracts with mining companies. The total value exceeded $2 billion. For context, Morgan Stanley had spent 3 years building this position. They had publicly stated, multiple times, that silver represented a strategic hedge against inflation and dollar weakness. Their research department had published bullish reports, recommending clients increase precious metals exposure. Now, in less than a week, they were gone. The silver market, which trades approximately 200 million ounces daily, barely registered the activity. Morgan Stanley's execution was surgical. They spread the sales across multiple exchanges, used algorithmic trading to disguise order sizes, and coordinated with other major dealers to absorb the volume. To the average investor watching price charts, nothing seemed unusual. Silver dropped 3% that week, a normal fluctuation. But to those who understood market mechanics, who could read the language of institutional order flow, the signal was unmistakable. Something had changed. Morgan Stanley is not a retail brokerage making emotional decisions. They are one of 5 institutions that effectively control commodity price discovery. They have access to order flow from mining companies, industrial consumers, central banks, and sovereign wealth funds. They see what the market is going to do before the market knows itself. When an institution of this size exits a position completely, it is never random. They do not panic. They do not react to headlines. They operate on information, hard data, and forward-looking models that process millions of data points. The memo leaked for a reason. Someone inside Morgan Stanley, someone with access to executive-level communications, wanted the market to know. Whether it was a whistleblower, a concerned analyst, or a calculated leak designed to move markets, remains unclear. But the message was received. Within 48 hours of the leak, 3 hedge funds specializing in precious metals began reducing their silver exposure. 2 large ETFs saw unusual redemption activity. Mining company stocks, particularly those focused on silver production, started declining on higher than average volume. The institutional community was watching. Morgan Stanley refused all media requests for comment. Their public relations department issued a standard statement. We do not discuss specific trading positions or portfolio decisions. Behind closed doors, however, conversations were happening. Conference calls between risk managers, encrypted messages between trading desks, hurried meetings in corner offices overlooking Manhattan. Because if Morgan Stanley knew something, if they had information significant enough to abandon a multi-billion-dollar position, then every other institution needed to know what it was. The financial world operates on information asymmetry. Those who know first profit, those who know last lose. And right now, Morgan Stanley knew something. The leaked memo revealed the action, but not the reason. It showed the decision, but not the data behind it. It confirmed the liquidation, but left the most important question unanswered. What did Morgan Stanley see that forced them to abandon silver completely? What information crossed their desk that changed everything? The answer lies in understanding the economic context surrounding this decision, the global forces, the market structures, and the hidden pressures that make silver, right now, more dangerous than most investors realize. 3 months before the memo was written, something unusual happened in Basel, Switzerland. The Bank for International Settlements, the central bank of central banks, published a research paper that almost nobody read. Buried on page 47, in dense technical language, was a single paragraph about commodity market exposure among major financial institutions. It mentioned that derivative positions in precious metals had reached levels not seen since 2008. Morgan Stanley's risk management team read that paragraph. They read it very carefully because, unlike public investors who buy silver coins or small ETF positions, major banks like Morgan Stanley operate in a completely different universe. They do not simply buy and hold. They create complex derivative structures, futures contracts, options chains, and swap agreements that can magnify exposure by factors of 10, 20, even 50. In the silver market, this matters more than anywhere else. Silver is the smallest major commodity market by total value. The entire above-ground silver supply available for investment, approximately 2 billion ounces, is worth roughly $60 billion at current prices. For comparison, Apple's market capitalization is nearly $4 trillion. A single tech company is worth 65 times the entire investable silver market. This creates a dangerous dynamic. When large institutions enter silver, they dominate it. When they exit, they can collapse it. And right now, the conditions that made silver attractive 3 years ago have fundamentally reversed. In 2021 and 2022, the world looked very different. Inflation was accelerating. The Federal Reserve was printing money at unprecedented rates. The dollar was weakening. Industrial demand for silver, particularly from solar panel manufacturing and electric vehicle production, was projected to grow exponentially. Morgan Stanley built their position based on this thesis, but by late 2024, the landscape had transformed. The Federal Reserve had raised interest rates to levels not seen in 2 decades. Inflation, while still elevated, had cooled significantly. More importantly, the dollar had strengthened against every major currency. A strong dollar makes commodities, which are priced in dollars, more expensive for international buyers. Demand began softening. China, which consumes 25% of global silver production, was experiencing its worst economic slowdown in 40 years. Real estate collapse, manufacturing contraction, and deflationary pressures were reducing industrial consumption across all base metals. Then came the data from the solar industry. Silver is critical in solar panel production, accounting for roughly 10% of annual industrial silver demand. For years, analysts projected explosive growth. Governments worldwide were subsidizing renewable energy. The green transition seemed unstoppable. But in October 2024, Germany announced it was cutting solar subsidies by 40%. Spain followed, then France. Budget constraints and political shifts were changing the equation. Solar panel installations in Europe, the second largest market, were projected to decline 15% in 2025. Morgan Stanley's analysts saw the numbers. Then they looked at supply. Mining production, which had been constrained for years due to underinvestment, was suddenly increasing. New mines in Mexico and Peru were coming online. Existing operations were expanding. The deficit that had supported silver prices for 3 years was turning into a surplus. But these factors alone, while significant, were not enough to trigger a complete liquidation. Institutions manage risk. They adjust positions, they hedge exposure, they do not abandon assets entirely unless they see systemic risk. And that is what Morgan Stanley found. Their quantitative analysts had built models, sophisticated algorithms that processed thousands of variables, tracking everything from central bank policy to warehouse inventory levels to options market positioning. In November 2024, these models began flashing warning signals. The silver futures market, where most institutional trading occurs, was showing extreme concentration. A small number of players held enormous long positions. Hedge funds, family offices, and even some retail-oriented investment vehicles had piled into silver, believing the inflation narrative. This created what risk managers call crowded trade syndrome. When everyone is positioned in the same direction and something changes, the exit becomes chaotic. Morgan Stanley's models calculated the probability of a forced liquidation event, where falling prices trigger margin calls, which force selling, which drives prices lower, which triggers more margin calls. A cascade. The probability was rising every week, and Morgan Stanley knew, from bitter experience, what happens when they are caught on the wrong side of a cascade. In 2008, Lehman Brothers collapsed, partly because they could not exit positions fast enough when markets turned. Morgan Stanley nearly followed them. They learned a lesson that year. A lesson written in survival. When the models say exit, you exit. Before anyone else sees what is coming. Before the crowd realizes the door is too small for everyone. But there was something else, something the memo did not mention, something only a handful of executives knew, and that piece of information changed everything. On December 4th, 2024, 2 weeks before the liquidation memo was issued, a Morgan Stanley executive received a phone call. The call came from Washington, not from a regulator, not from a politician, but from someone whose job description does not officially exist. Someone who coordinates between the Treasury Department, the Federal Reserve, and major financial institutions during periods of systemic stress. The conversation lasted 11 minutes. No recording exists, no transcript was filed, no mention appears in any official log, but when the executive hung up, he immediately scheduled a meeting with the head of risk management and the chief of commodities trading. What was discussed in that phone call remains unknown to the public, but the outcome was the complete liquidation of Morgan Stanley's silver holdings. This is how modern financial markets actually work. The public sees prices on screens, reads news articles about supply and demand, believes markets move based on fundamentals and investor sentiment. The reality is far more complex. Major financial institutions do not operate independently. They function as interconnected nodes in a global system where information flows through unofficial channels, where decisions are coordinated without explicit agreements, where systemic risks are managed through quiet conversations rather than public announcements. Morgan Stanley's exit from silver was not an isolated decision. It was a signal. And other institutions were watching carefully. Within the world of commodity trading, there exists an informal network. Risk managers at Goldman Sachs talk to risk managers at JP Morgan. Trading desk heads at Citigroup exchange information with their counterparts at HSBC. Not through official channels, but through relationships built over decades. They attended the same universities, worked at the same firms early in their careers, see each other at industry conferences and private dinners. When one major player makes a dramatic move, others take notice. By December 23rd, just 5 days after Morgan Stanley's liquidation, JP Morgan had reduced its silver exposure by 40%. Goldman Sachs began unwinding long positions in silver mining companies. Citigroup quietly canceled plans to launch a new silver-focused investment product. The institutions were moving in coordinated silence. But why? The answer lies in understanding what these institutions know that retail investors do not. They have access to a different layer of market intelligence. Morgan Stanley can see, in real time, how much silver is flowing into ETFs versus flowing out. They can track physical movements from refineries to vaults to industrial consumers. They can analyze order flow from central banks, mining companies, and sovereign wealth funds. More importantly, they can see leverage. In modern markets, very few participants own assets outright. They borrow to amplify returns. A hedge fund with $100 million might control $500 million worth of silver through futures contracts and margin. This works beautifully when prices rise, but when prices fall, the mathematics reverse brutally. Morgan Stanley's internal analysis had identified approximately $12 billion in leveraged silver positions across the market. Hedge funds, commodity trading advisors, even some pension funds had borrowed heavily to bet on continued price appreciation. These positions were vulnerable. If silver prices dropped 15%, margin calls would force liquidation. That forced selling would drive prices lower, triggering more margin calls, creating a self-reinforcing cycle. Morgan Stanley calculated the cascade potential. Their models showed that a 20% decline in silver prices from current levels could trigger forced liquidation of nearly $8 billion in positions. That amount of selling, in a market that trades only $5 billion daily, would be catastrophic. Prices would not decline gradually, they would gap down, limit down. Trading would halt, liquidity would vanish, and anyone still holding positions would be trapped. This is what institutional risk management prevents. Morgan Stanley was not predicting this would happen. They were identifying the possibility, calculating the probability, and deciding they did not want exposure if it did. But there was another dimension to their decision, one that few outsiders understand. Regulatory pressure. Since the 2008 financial crisis, banks have operated under increasingly strict capital requirements. They must hold reserves against potential losses. They must demonstrate their positions are not creating systemic risk. Silver, despite being a relatively small market, had become problematic. The Bank for International Settlements, in that obscure research paper published months earlier, had flagged precious metals, derivatives, as an area of concern, not because of immediate danger, but because of concentration risk. Too few institutions controlling too much exposure in too small a market. Regulators were asking questions, not publicly, but in private meetings, in confidential reports, in the kind of conversations that never appear in newspapers. Morgan Stanley's legal and compliance teams had advised that maintaining large silver positions, particularly leveraged positions, could invite regulatory scrutiny. And in the current environment, where bank failures were fresh in public memory, where political pressure on financial institutions remained intense, inviting scrutiny was strategically unwise. Better to exit quietly before questions were asked, before positions became public through mandatory filings, before they had to explain, in congressional hearings or regulatory inquiries, why they had maintained exposure to a market showing signs of instability. So they sold all of it in 72 hours. And the memo leaked, perhaps intentionally, to ensure other sophisticated investors understood the signal. The institutions were exiting, the smart money was moving. The question now was not whether silver would decline. The question was, how far, how fast? And who would be left holding positions when the cascade began? Because in markets, timing is everything. And Morgan Stanley had just announced, without saying a word, that the clock was ticking. In January 2025, 3 weeks after Morgan Stanley's liquidation, a small investment firm in Dallas received a letter from their largest client. The client was a family office, managing $800 million accumulated over 3 generations of oil and gas wealth. They held $40 million in silver, physical bars stored in Delaware vaults, and silver mining stocks. The letter asked a simple question. Should we be concerned? The portfolio manager, a veteran with 25 years of experience, spent 2 days researching before responding. He looked at the data Morgan Stanley had access to. He examined the derivative positions. He calculated the leverage ratios. He studied the industrial demand forecasts and supply projections. Then he called the client. "Oh, we need to meet," he said, "in person." This conversation, multiplied across thousands of investment firms, family offices, and corporate treasuries, represents the real impact of Morgan Stanley's decision. It is not about silver prices moving 3% or 5%. It is about the framework through which sophisticated investors make decisions when major institutions signal danger. Because the challenge is not knowing what Morgan Stanley knows. The challenge is deciding what to do when you do not have their information, their analytical capabilities, or their ability to move positions quickly. For business leaders managing corporate cash, the calculation is different than for individual investors. A manufacturing company holding silver as an inflation hedge faces operational considerations. If they liquidate and inflation accelerates, they lose purchasing power protection. If they hold and prices collapse, they experience unrealized losses that impact balance sheets and shareholder confidence. The framework for decision-making must account for multiple scenarios. First, assess actual exposure. Most businesses and investors overestimate their understanding of what they own. They see silver ETF on a statement and assume they own physical metal. In reality, many silver investment vehicles hold futures contracts, derivative instruments, or shares in mining companies. Each carries different risk profiles. Physical silver, stored in allocated vaults, cannot be rehypothecated or seized during a financial crisis. It has counterparty risk only to the vault operator. Silver ETFs, depending on structure, may hold physical metal or derivatives. During market stress, redemption mechanisms can break down. Prices can disconnect from underlying asset values. Silver mining stocks are equity investments subject to operational risks, management decisions, and leverage ratios that have nothing to do with silver prices themselves. Understanding what you actually own is the first step. Second, evaluate time horizon and purpose. An investor holding silver as a 10-year inflation hedge operates differently than a trader seeking 6-month returns. Morgan Stanley's exit does not necessarily invalidate long-term fundamental cases for precious metals, but it does signal that the next 6 to 12 months may involve significant volatility and potential downside. For those who can withstand mark-to-market losses, who have no need for liquidity, who are genuinely positioned for decades, the institutional exit may be irrelevant. For those managing quarterly performance, or approaching retirement, or operating with borrowed money, the calculus changes entirely. Third, monitor specific leading indicators. The advantage retail investors have, like in the age of information, is access to the same data institutions watch. ETF inventory levels are published daily. When silver ETFs show sustained outflows, physical metal is leaving vaults. This confirms institutional selling beyond Morgan Stanley. COMEX warehouse stocks, reported weekly, reveal whether physical silver is accumulating or depleting. Rising inventories during price weakness indicates lack of buying interest. Mining company hedge books, disclosed in quarterly filings, show whether producers are locking in future prices. Increased hedging suggests companies expect lower prices ahead. Options market skew, the relative pricing of puts versus calls, reveals whether sophisticated traders are buying downside protection. Elevated put prices indicate fear. Industrial purchasing patterns, tracked through manufacturing PMI data and metals consumption reports, signal real demand trends beyond investment speculation. These indicators, updated regularly, provide ongoing assessment of whether Morgan Stanley's concerns are materializing. Fourth, consider alternative positioning. The question is not simply hold silver or sell silver. There are gradations. Reducing position size from 10% of portfolio to 3% maintains exposure while limiting downside. Shifting from leveraged vehicles to physical holdings eliminates margin call risk. Rotating from silver to gold maintains precious metals exposure with less volatility and deeper liquidity. Moving to cash preserves capital for opportunistic reentry if prices decline significantly. Each option carries different risk-reward profiles. Fifth, establish trigger points for action. Emotional decision-making destroys wealth. The time to decide what you will do is before market stress forces the decision. If silver falls to $25 per ounce, will you buy more or sell everything? If mining stocks decline 30%, does that represent opportunity or confirmation of fundamental deterioration? If major industrial consumers announce reduced silver usage, how does that change the thesis? Defining these decision points in advance removes emotion from execution. But there is a broader lesson beyond silver, beyond commodities, that Morgan Stanley's liquidation teaches. Institutional behavior is information. When major players exit positions, they are not always right. Markets are complex. Predictions fail. Even sophisticated models miss turning points. But they are operating on better information than most investors will ever access. They see order flow. They talk to central banks. They have relationships with mining executives and industrial consumers. They employ teams of analysts who do nothing but study single commodities. When they move, it deserves attention. Not blind following, but serious consideration. The investor who ignores institutional signals because they have been wrong before is making a different bet. They are betting their analysis, with public information and limited resources, is superior to teams of professionals with proprietary data and decades of experience. Sometimes that bet wins, but it requires extraordinary conviction, backed by extraordinary evidence. For most, the prudent path is to acknowledge the information asymmetry, to respect that institutions see things earlier, and to adjust positioning accordingly, not in panic, but in measured response. Morgan Stanley has exited silver. They did so quickly, completely, and based on information they chose not to share publicly. The decision now belongs to everyone else. To hold requires believing you see something they missed. To sell requires accepting you may be wrong about timing. To wait requires discipline and predefined action points. But to ignore, to dismiss institutional behavior as irrelevant, to assume markets are driven only by fundamentals visible to all, that is not strategy. That is hope. And in markets, hope is not a framework for decision-making. It is a path to learning expensive lessons. After it is too late to act, the signal has been sent, the institutions have moved. What happens next depends on whether the crowd recognizes what the professionals already know, and whether they act before the exit becomes crowded.